Welcome to the Standard Deviations podcast, presented by Orion Advisor Solutions and hosted by Dr. Daniel Crosby, Orion's Chief Behavioral Officer and New York Times best-selling author. Today's investors expect more than a transaction. They want a relationship. Show how your firm merges EQ and IQ with Orion's VFi 20, a new shareable assessment developed by Dr. Daniel Crosby that provides you with emotional and attitudinal insights into clients to facilitate more meaningful investing conversations from day one. Get started today at orion.com/BFi20.
Hello and welcome to the Standard Deviations podcast. I'm your host, Dr. Daniel Crosby, and today I am joined live from Orion Ascent here in sunny Orlando, Florida, by my favorite investment professional who also served a brief stint as a cowboy, Rusty Vanneman. Rusty is my go-to investment mind. He is actually my go-to music mind, musical genius, and someone who appreciates investing as a true liberal art. Welcome to the show.
Daniel, it's great to be back.
What an intro, right?
Yeah, that was pretty awesome. Yeehaw.
Yeah, what an intro. All right, man. So I want to start out. We're going to go shrink on you first thing. One of the most enjoyable parts of grad school for me was finding what psychologists call a theoretical orientation. So let me set this up a little bit. This is an organized set of assumptions or preferences for given theories that provides a therapist a conceptual framework for making decisions in a therapeutic context. Like, if you ever listen to the NPR, This I Believe, this is like the This I Believe about how people grow and change. I feel like investment professionals need the same kind of thing. What is the philosophy of investing you ground yourself in, and how does it keep your head on straight when you're making great investment decision?
Oh, wow. I love this question. I guess you could say I believe in the power of I believe. And, I think it's important to have a philosophy. And this is relevant for investment managers, for financial advisors, for investment leaders, as a human being, quite frankly. And I think that when you say I believe and why I believe this, I think really all investment decision makers should be able to answer this. Quite frankly, I think it's really important. And there's different kind of philosophies, but it's really important to kind of stick with that philosophy. And I think investors should be asking their financial advisors, and I think due diligence analysts should be asking their investment managers what they believe and what their philosophy is. So I think philosophy is key. I always say that people chase performance, but really the most important thing about picking a strategy, an investment manager, is making sure there is a philosophy fit. And when there is, it's a win-win-win. So it's obviously a win for the investment manager because the assets will be stickier. It's a win for the financial advisor because the assets are stickier. But most importantly, it's going to be a win for the investor because they're going to be able to stick with the strategy through thick and thin. They're not going to be chasing performance, as we all know. It's really about the philosophy fit. So one more tangent I just want to say is, and I just is kind of a little pet peeve, and I'm just going to throw it on you right here, is, a lot of people use the phrase evidence-based investing. Now, first of all, I like it. There's some really good people who kind of use that phrase, but there's lies and statistics, right? And so many people say evidence-based, but they're playing with stats. And I really think investing is almost faith-based. Now, when you say faith-based, now there's a different connotation to that. So maybe it's philosophy-based, but I think it's like you really got to follow what you believe. Don't chase the numbers, determine what your philosophy is, and stick to it.
Yeah, so Dan Egan, I don't know if you've ever had this experience as a content creator, but Dan Egan at the head of behavioral finance over at Betterment wrote a blog post that I'm still angry that I didn't write first. And it was about the need for investors to have a faith, and that was kind of the word he used. And he makes the point, and I agree, that it doesn't much matter what that faith is. Like, it could be momentum, it could be value, it could be low cost, it could be indexing, it could be 100 things. They all work in different markets. But it's about believing in something deeply and adhering to that. And it was interesting for me, as an outsider to the investing world, to come in and learn about these things. And some things just didn't fit with just kind of my worldview, my personality, whatever. Some did. The other idea I like, so I like your idea for asset allocators to ask the people they're considering allocating to, what's your faith, so to speak?
Yeah.
And if they can't explain it to you concisely and simply in 5 minutes, it's not a real faith.
I totally agree.
The other thing that I think excessive complexity is actually sort of counterintuitively evidence of shallow understanding.
I call it the Wizard of Oz treatment.
Or BS.
Yeah.
Right? Yeah, exactly. The man behind the curtain kind of thing. The other thing that Patrick O'Shaughnessy talked about, wish I'd written this one too, is an investment graveyard. It's kind of like, this I don't believe. Like, these are things that I tried that didn't work. And I think that's another thing to keep top of mind.
Right on.
Yeah. So, even
at this conference, I've seen stuff. It's like, I even thought, I wish I had written that. I've already seen that at this conference as well. So I totally agree with that piece by Dan Egan, which I have not read, but now I'm going to have to track it.
It hurts. I hate you, Dan. So you and I have the opportunity to talk about a few things with some regularity. One of them's music. The other one is behavioral finance.
Yeah.
And I'm curious, for someone like you who's in a position to make material decisions about other people's money, what responsibility do you have to do the work, so to speak, around understanding your own values, your own biases, your own behavior? And what does this look like practically in your own life?
Well, the reality is I take all these tests. I always want to find out. There's so many different sort of surveys, like what type of investor are you? And I mean, even some of the tools you've created, I've taken them. I do that. So these B520s, for instance, I love, the risk tolerance questionnaires. I'm always trying to find out, what kind of investor I suppose. I kind of know. I kind of know what it is at this point. But it's also about your values too. And that's what makes everybody truly unique is, what are your values? And so I love taking those strength finders, you name it. Give me a test, I'll take it, is what I'll really do. And I think when it comes to not only is creating that awareness, but it's also continually studying about it as well. So reading, studying, and thinking about behavioral finance. It's reading books, listening to podcasts. I mean, I'm a believer in it, and I think it's really important because so much decision-making, quite frankly, is driven by noise, trivia, and emotion, and you really have to minimize that, if not eliminate it, as much as you can.
What was the most surprising thing you learned about yourself in that process?
Ooh, good question. The most surprising thing, I think like on the strength finders. You ever done strength finders?
Yeah.
Yeah. What are your strengths? I'm putting you on the spot. You're shelled at the end of at the Ascent. You've only given 17 presentations. How do you not remember this?
I totally don't remember because I took it 12 years ago or something.
So, I mean, I don't know. This may not be the best answer. The first thing that comes to my mind is I've done strength finders a bunch of times. My same strengths come up all the time, but people always say, like, how did competition not come up for you?
Yeah.
So seriously, you're one of the most competitive people I know. You always want to win. It's like, it doesn't even show up on my list. So I think competition in their mind is I'm always striving to get better. So I'm always learning, and I'm trying to better myself. So I'm competing against myself, but it doesn't show up in the strength finder. So that's the first thing I thought of. That's kind of surprising. It's surprising to others.
Yeah.
That's not one of my strengths.
What are your love languages? Okay, next. I know my love. I know my love languages, but not my strengths. It's time for me to do the work. Staying on the topic of behavior, but now kind of moving from you as an individual to as an institutional decision maker here at Orion. What steps does Orion, the institution, take to try and avoid falling prey to behavioral missteps?
Well, I can tell you my experience in managing various investment teams over the years is, one, it does go back to having a philosophical backbone. And, all investment decisions are tethered to it and have to be consistent to that philosophy. We always talk about due diligence. People always talk about all the various P's, philosophy, people, process, and everything. When it comes to, I'll just pick on 3 P's here and kind of describe how I've always believed that institutional money should be managed is that first philosophy, that first P is you have to articulate your philosophy and why you have it and defend that philosophy. You guys say why you believe it. Now the process comes out of that philosophy and the philosophy has to inform the process. The process can change. It gets enhanced over time. Then the positioning, never fall in love with the position. The positioning is completely driven by the philosophy and the process. So if the facts change, you change your position. A lot of investors flip it. They love their positions. They don't have a philosophy. And I think sound investment management has to kind of go in that order. So I also believe philosophy can be quantified to some extent. If a firm does like expected returns, for instance, that kind of captures what they believe. Like, how did you build your expected returns? And are you building your portfolios around it? That essentially captures what you believe. A firm has expected returns. They have a philosophy. I also think, just 2 more quick things, I could probably go on and on this, but when it comes to forecasting returns, one big thing that my teams do is if they have to do a forecast, it isn't a number. It isn't like, what's the market going to be up next year, like 8%? What we do is we look at the historical experience of returns. How often is the market above 20%? How often is it between up 10 and 20%? How often is it between up 0 and 10, and so on and so forth? And you have these different levels. And you have that base case experience. How often has it happened in each? So your forecast is first driven off that base case. And then given what the current situations are, like valuations, earnings, what factors do you believe in, then you adjust it. So I think that expected returns is really healthy way of doing it. It's also very humbling. It's also why you diversify portfolios. I hate it when people just give single numbers, It just gives a false level of precision. One more thing is I had an award. I don't have this now, but I have an award, but this really kind of captures, again, the way I felt like when it comes to investment teams, need to think and interact with themselves. Is my most prized team award was the Maverick Award. Have I ever told you about this before?
I don't know this award.
All right, so the Maverick Award can be quantified. There's sort of 3 different things you look at. So first of all, you have to have a view. So on any investment, you could be bullish or bearish or neutral. It's cool. You can be either one of those, but you got a point if you're bullish or bearish. Have a view. The second thing is you got a point if you're out of consensus. So once everybody voted, if you were out of consensus, you got a point for that. If you were a consensus, lost a point. Third thing is if you change your mind from month to month, because most investment people, once they make a stand, they don't change their mind. They usually sink at some point because they defend their position to death. The facts change. You change your mind. You change your position. So if you had opinion, you were out of consensus, you changed your mind for good reasons, you just couldn't flip-flop, you won the Maverick Award. And that
Did you have to be right? Was there any?
Oh, yeah, actually would judge that 12 months later. That was another set of awards. But the other award that was related to the Maverick is if you actually quantitatively was the last place, you got the WIMP Award. But that was an award that we had within the team, and I think it was very healthy. We had healthy debates. You could be out of consensus, because a lot of people are scared to be out of consensus. But as a good investment person, so I figured those are some things. I could go on. Sorry.
I like the
Right, cool.
I like the Maverick
Yep.
Award. We need to make that happen. So one of the interviews on this show that has stuck with me the most was with Jim O'Shaughnessy of What Works on Wall
Great work,
Street,
yeah.
O'Shaughnessy Asset Management fame. And Jim talked about, I asked him about his proudest moment in his, he's had a very storied career, a ton of successes, doing cool things to this day. Love you, Jim. And what I asked him about his biggest triumph, and he said it was staying true to his philosophy in the worst parts of the great financial crisis. And he said, I think this is sort of anecdotal. He said 2/3 of the nominally quantitative asset managers that he knew abandoned their philosophy, kind of at just the wrong time, fell prey to this behavioral trap. You talked about changing your mind. It's such a hard thing, in my estimation, to know when you're being wimpy, right? And just sort of capitulating to some behavioral misstep. And when you're making a more principled, when the facts change, I change my mind sort of thing. How do you make that distinction?
Well, I think when people change their philosophies, I think it's a little bit of a dirty secret in the industry. Obviously at the individual level, there's such a thing as career risk. Some people have pretty nice lives. They got big mortgages, nice cars. You know what? It's career risk. But I think even bigger than career risk is business risk. And so it's the investment leaders managing investment personnel. They put pressure on their own investment organization, their own investment personnel. And so when a lot of those philosophies change, it isn't necessarily the investment professional flip-flopping. Sometimes they're getting pressure and it's creating career risk. A lot of the performance chasing in our industry, we put it on the individual investor a lot. Sometimes the investment leaders of organizations are causing it. Sometimes it's the sales professionals of organizations causing it when they have a product line that's got a bunch of different products. Sometimes it's financial advisors that are also creating the performance chasing as well. So it really comes back, everybody should have a philosophy and fit it to within that organization and be able to stick to it. Did I answer your question? I think I said something that I wanted to say, but I'm not sure if I answered your question.
No.
Yeah, cool.
This is, we start these podcasts without a name, and the name just emerges, and this is quickly becoming the philosophy podcast.
Awesome.
This is becoming the theoretical orientation podcast.
Nice. I like
love it. One of the things that I think about a lot, Greg Davey, we're going to give lots of shout outs today. So Greg Davies, formerly of Barclays, over in the UK, wrote a book a while back, and he introduced this term to me called about anxiety adjusted returns, and I just love it because it's pretty easy to compute an efficient frontier to create a portfolio that is, we'll call it spreadsheet optimal. But then that portfolio is, held by and ridden by a real human being with real human frailties. And I love this idea of creating portfolios that sort of conform to the human that owns them. How do you think about maximizing anxiety-adjusted returns and creating human-first sort of bespoke portfolios?
I'll answer this from the institutional level and the individual level. So from the institutional level, if you want to maximize anxiety-adjusted returns, as a professional, you have a mandate. And again, you have a philosophy. Articulate them. Say what you're going to do, why you're doing it, and then do it. Just it's that simple, And I mean, you have an investment mandate, and you really need to articulate it. And not only that, it's not only important for you as the manager, it's also important for the consumer of your investment portfolio. If you clearly state what you're doing, then they should also know when it's going to work, when it's not going to work, and then there should be no surprises anywhere. As an investment professional, if you are executing on what you're saying you're doing, that should reduce your anxiety. Now, at the individual level, it's easier said than done, right? But I think the key here is a lot of people talk about what we're trying to do is goals-based investing, and I get it, right? But you know what? It's really more about values-based investing. That's really the key because goals change, it's goals-based is like MBT and Monte Carlo. They're all valuable exercises to go through to kind of know where you're going. But really, ultimately, it is when somebody sits down with an individual investor or when the individual investor is going through the discovery process themselves, what are their values? Their values can be different than everybody else. But when you know your values and you're making financial decisions, including investment decisions, and they're consistent with your values, that should be able to reduce your anxiety over time.
Yeah.
So I really think it's, a lot of times everybody talks about goals-based investing, and I get it. I mean, it is. You have goals. They're tangible, and the values are more intangible, but it really is about investing with your values because we don't know what the future is going to be.
Well, one of the things that I love to do is announce things that aren't ready yet and drive our devs crazy. So with apologies to all the tech folks at Orion, one of the things that we're working on right now is tying financial planning to values, then to goals, then to behaviors.
Yeah.
Because when we look at goals, you're exactly right. They're highly mimetic, right? They're kind of pulled from thin air sometimes. If your neighbor got a boat, then you want a boat. There's a lot of recency bias.
Goals change. Right.
Yeah, the goals change.
Values don't.
Values are enduring.
Yep.
We want to anchor people in values, then talk about the specific goals that feed those values, then talk about the specific behaviors.
Hallelujah.
Get them there. Let's go. Sorry, devs.
Can we have that next week?
Yeah. That's due before this podcast airs.
Yeah. Another thing too is just getting the risk right too. I mean, that's, there's a lot of different surveys what investors want. Another survey that came out from Kitsis recently is what do investors want from their advisors? And it's, there's a lot of different surveys. We have our own at Orion too, but it is obviously they want the comprehensive view. They want them to call you back quickly is another big thing. Yeah. Please just call me back. And the other thing is getting the risk right. That is a really important part. And you speak about that all the time too. You speak about some other things too, but getting the risk levels right. And so in terms of kind of reducing anxiety, it is always a discussion about risk. And then the more comprehensive the risk survey is, you don't do a 2-minute survey. Yeah. That's just not doing justice to it. Yeah. I mean, the deeper an advisor can go with an investor, drilling into risk, tolerance capacity, the emotional capacity for risk, the risk composure, that is, I think, really critical as well for.
Yeah.
Hallelujah again.
Yeah. Hallelujah.
Okay.
Amen. So I'm throwing you an alley-oop right here.
An alley-oop.
Here comes the alley-oop.
All right.
Better hammer this home. So there is a folk.
Oh, you know what? Can I just totally interrupt you for a second?
Yeah. No, go.
You know what? I got you. I have you, and I've got you on the spot. I'm going to hijack your podcast for a second.
Oh, I see how it is.
You are the BFI. Sometimes people do this to me on my podcast, but okay, you're a BFI expert. Here you are. So I have some questions for you. You've worked with, and you're really popular, a lot of investment professionals, not just financial advisors. But do you have a quick BFI thought or takeaway for various people involved in decision making? And I've got 5 different categories. I'm going to give them to you all right now. and then we'll go through one by one.
Okay, beautiful.
Because they're all sort of different. And I don't know if you've got a tip for them. And you've written so much about all this.
Not one question, 5. That's bold.
Exactly. I know. I'm hijacking this. So first of all, let's just say like an institutional investment decision makers, like a mutual fund portfolio manager. Oh, do you want me to go through all 5 first, or just take one at a time?
One at a time.
Okay, cool. So an investment decision maker, like a mutual fund PM, what is like one key takeaway? If you could like come in, you're getting paid right now to give like a takeaway to a PM.
Yeah. So my hottest take on institutional investing is that most of what passes for due diligence is useless. So things like site visits, manager handshakes, looking a person in the eye and kind of getting the cut of their jib, all useless. And there's...
You mean if they're wearing a really nice suit, that doesn't matter?
That's right. Well, I think there's a huge amount of sunk cost involved with all the things I just mentioned, flying out to meet someone. There's some sort of optimistic predisposition to even doing it in the first place because you're not going to go have the meeting if you're not 90% of the way there. And then I think there's a big sunk cost piece to it too. People look for reasons for it to be a worthwhile trip. And the same way that studies in academia that don't sort of meet a threshold don't get published, it's hard to go, let's bring a team out, let's vet these folks, let's take them out to dinner, let's hear about their process, and then tell them no.
Finally, it's definitely unconventional.
Yeah, so I think a lot of what passes for due diligence is a waste of time, and you'd be better off looking at someone's philosophy, A, and their adherence to that philosophy, B, and going with the numbers.
Well, that was my second question actually about due diligence, but related to that is how about an investment research analyst or research team? So like people supporting PMs. Yeah. Any sort of tips for them? So their role's a little different. Yeah.
So here's what I think for that crew. I think you want to look at things that have 3 components to them. I write about this in The Behavioral Investor. They need to be philosophically sound, right? You're looking for ideas that are philosophically sound so they make sense, right? My favorite example is like there was for years there was like a 96% correlation between the price of butter in Bangladesh and the S&P 500, right? But if I came to you and said, invest in my Bangladeshi butter production hedge fund, like you should laugh at me because it's stupid. Like
if it works though.
Yeah, no. It's not philosophically sound, right? So it needs to have some philosophical underpinning. The second piece is that it needs to show up in the data. So, right, the Bangladeshi butter shows up in the data, but it doesn't check the philosophy box. And then it needs to be undergirded by some sort of behavioral principle, which is why it sticks around. Because if you look at sort of the ideas that crew is looking for, so many of these ideas get arbitraged away as soon as they're made publicly available. But things like value and momentum work because they're behavioral at their core. And, we can trace momentum back to biblical times.
Yeah.
And it's worked for thousands of years, and it will work for thousands of years from now because it's behavioral at its core.
Yeah, that's great. This is fun running your podcast. Well, 2 more questions, sorry. What about for non-investment professionals responsible for managing investment teams?
So non-investment professionals...
So they're obviously investment industry, but let's say they came from different backgrounds, and now all of a sudden they are tasked to manage an investment team. I mean, the reason I ask is because investment personnel, generally speaking, they should be wired differently. They have to think differently. They have to be contrarian, right? And a lot of other people who are running organizations, salespeople have to connect. They want to connect with people. And an investment person, a really good one, looks at somebody else and they want to disconnect. Why am I better? Why am I different, right? So have you ever been in a situation you had to give counsel to a manager of investment personnel who's not an investment person?
So I have not, and I'm going to introduce, in a very squirrely way, I'm going to introduce a behavioral concept here. There's a behavioral concept known as meta-knowledge, which is effectively knowing what you don't know. Yeah. I don't know enough to answer this question. And so I think there's times in our investment lives, I've never done that. I've never dealt with the people you're mentioning. I don't know any research on that. Yeah. And so I think you bow out. That's cool. What I'm doing.
All right. Okay, the last one, I think this is actually a really good one too, is because I bet most people listening to this podcast, they have the ability or they're already on an investment committee. So if you're an investment committee member, any sort of tips as being a good IC member?
There's a couple of good tips for investment committees. One of the things that typically happens is that the most senior, highly compensated, most senior in the organization person kind of leads the meetings, goes first, starts and closes the meeting. And one of the things that we find is that it's hard to dispute the general understanding of that first person. So if that person makes a claim and sort of puts a stake in the ground about what they believe to be the reality of whatever's being discussed, what we find is that most opinions orbit around that initial sort of statement that's made by that most senior person, whether it's the beginning, whether it's in the middle. So there's a couple of things. First of all, if you're soliciting ideas, everyone must come to the meeting with their ideas written down, pre-planned, and they cannot be subject to the sort of winds of that meeting, right? You've got to come to the meeting prepared, and you have to present your ideas as they exist in your mind on that paper before you come. That's one idea. And the second idea is you have to rotate who's in charge, right? The most junior to the most senior. You take turns leading, and you don't sort of default to organizational hierarchy, because as much as powerful people give lip service to wanting dissent and wanting opposing ideas, no one really wants that stuff.
Right.
And I think especially powerful people make that known in ways big and small and quash dissent. And so I think those are two things. Prepare before, share your best ideas, debate them, and take turns with who's running the meeting and who's in charge, so that the most powerful.
That's really awesome. Those are great tips.
Yeah.
I've been on various investment committees for nonprofits and whatnot, and those have been really useful. Cool. Well, you know what? I'm going to quit hijacking your podcast.
Yeah, can I have it back?
I'm
now?
so sorry.
Have it back now?
That was great, though. I really appreciate it.
No, that was fun. I was trying to throw you this oop, but I got you.
All right.
You blocked my shot.
Oh, no. I hope you still give me an alley-oop, though.
Here comes the alley-oop, okay? You're a Nebraskan.
Yeah.
There's another Nebraskan who people have heard about, a folksy old guy from Omaha with a poor diet.
Yep.
And he's known for giving short, memorable aphorisms for governing our behavior in the market. As a fellow Nebraskan with a better diet, who is at least as folksy, take us out with a Rustyism that we can remember when trying to decide what to do with our money.
This isn't really an alley-oop. I mean, it's following Warren Buffett. I mean, shoot fire is, but I do more taglines and mantras than pithy, wise sayings. But I mean, I do close all my communications with stay balanced and stay the course. I mean, it's just basically the essence of everything I write. And, I also write invest well and be well, because I just think that, it's an emphasis on smart investment decision-making, but also being healthy and having fun. In my latest monthly commentary, I use the phrase X+1, which I've used internally a lot, and it kind of describes not only how to work, but also providing investment product and service. X the expectations, but always go above and beyond. But I guess my fallback is in the close of my book I wrote years ago, is I do tell a story that it is a saying I say all the time, basically, personally to my kids. And my son asked me, do you apply this to investing? And basically the saying is, always be grateful, always be humble, always be strong. And he says, well, Dad, how does that apply to the markets? And so I said, well, it's easy, always be grateful, because, we have this wonderful opportunity to, as investors, participate in global growth, which is moving up and onward. But always be humble, because we don't know how this growth is exactly going to unfold. So we need to diversify portfolios, and then always be strong. And there's power in the planning, there's the power in the patience, there's the power in being disciplined. So that's not Warren Buffett, but I do taglines and mantras, and that's probably the best I have.
No, that's good. And it's less gross to think about than knowing who's swimming naked too. You know what I mean? I think yours is folksier. No, I actually really like that. And I like the invest well, be well. The whole book, my whole book, The Behavioral Investor, is just about, how things like diet, nutrition, exercise, the people you surround you with are exactly material considerations when thinking about running money. Now, I thought that one, I did alley-oop that to you. You did dunk it home quite nicely.
Nice.
You tomahawk dunked that. It was great. You were like Mac, the little white guy in this most recent dunk contest. No, you did a great job. Here's where it gets tough, though, because now in this lightning round, this is the real close. That was a faux close. This is the real close of the podcast. and you are up against Eben Burr of Taves Asset Management, who sit, 20 yards from us here at Orion Ascent.
He's legit music guy.
He's a legit virtuosic guitarist, legit music guy. I gave him similar questions to you, and he could not have done a better job a couple of weeks ago. I'm going to give you, so no pressure. I'm going to give you an investment concept, and I want you to name a band or a song that corresponds to that concept. Are you ready?
Yep.
Index funds.
Well, index funds are obviously steady market exposures, so No Surprises by Radiohead.
Wow.
What, was that how he answered it?
No.
Oh.
His stuff was massively esoteric. Like, I'd never heard of any of it. No Surprises is one of my favorite songs of all time.
Nice.
Yeah, so No Surprises, index funds. That's gorgeous. You're off to a hot start. Dollar cost averaging.
Well, dollar cost averaging is all about discipline. So how about we go with the song Discipline by Nine Inch Nails?
I don't even know the song Discipline by Nine Inch Nails. That's awesome. Discipline, dollar cost averaging. Tactical investing.
Well, I think proper tactical investing is really about risk mitigation and really about risk control. So it's really about risk. So risk, Deftones.
Risk, Deftones. Man, you're hitting some of my favorite bands here today.
I'm playing to my audience. I know my audience.
Primo workout music. Deftones, Run the Jewels, and Tool are my go-to workout music. Meme stock investing.
All right, so meme stock investing is really about chasing performance. So there isn't really a song called Chasing Performance, but I'm kind of going with a song that my kids used to love too. I'll just do Chasing Cars by Snow Patrol.
Chasing Cars by Snow Patrol.
It's chasing. It's about chasing.
It's giving Garden State vibes.
Yeah.
I like it. And the last one, and perhaps the toughest, scammy, no-name altcoin crypto.
Well, actually, I first was thinking the Strokes have a song called Bad Decisions, but I really thought the more appropriate song would be The Funeral by the Band of Horses, because hopefully it's just dead.
Yeah, it feels pretty dead at this point. And we'll give it Funerals by Arcade Fire, because I think it is.
Yeah.
It's pretty dead.
Yeah, exactly.
I think it's pretty dead. Rusty, this has been awesome. Pitch your podcast. Tell us where people can find you, where they can read your insights.
So I don't have one podcast. I have two. So I do have the weekly The Weighing Machine. You can find it wherever there are podcasts. Again, it's really it's produced for financial advisors who want to learn more about the markets and investment strategists and really anything a financial advisor or investor might be interested in. Then I have a monthly one right now called Weighing the Risk. And basically, it's a top-of-mind concern that financial advisors or investors might have, and then I bring out an outside guest. I give them 5 questions. Simple. The main questions, basically, they give answers which provide nice talking points on a key topic. And then I give 3 scenarios, and this is kind of the fun part of that podcast. I give 3 scenarios, a baseline case, a good case, and a bad case. And I kind of push it a little bit on the edges, I like to think. And the fun part is I want my guest to disagree and push back and tell me why I'm wrong. I do tell them, please don't tell me I'm completely, absolutely wrong. But anyway, so we go over these scenarios, and it's actually been a pretty big hit so far. So those are my 2 podcasts.
Well, that's huge. And I mean, it's practicing what you preached on this podcast.
Yeah.
It's very good. So even though you commandeered my whole podcast and
I was only on a third of it.
made me answer hard questions, this was a lot of fun. Great event. Thanks for being here, and always learn a lot when you're around. Thank you so much.
Thanks, Daniel.
Thanks for tuning in to Standard Deviations. If you can't wait till next week for more behavioral finance insights, visit www.orion.com. All opinions expressed by Dr. Daniel Crosby and podcast guests are solely their own opinions and do not reflect the opinion of or endorsement by Orion and its affiliates, subsidiaries, and employees. This podcast is for informational purposes only and should not be relied upon as a basis for legal, tax, and investment decisions. The opinions are based upon information the participants consider reliable.